Hi, my name is Contreras, and I'm a registered investment advisor. And in this video, I'm going to talk about how business owners can retire in 5 to 10 years. All right, so let's get to it. So let's say you're a business owner that you're in your 50s or 60s. You already have a business that you started over 30, 40 years ago, but you never did any type of savings for your retirement. But now, your business is doing very well. You're having large amounts of profits, large amounts of cash flow, and you want to know what you can do to quickly, retire or accumulate a good amount of retirement savings, so that you can retire sometime soon, or at least have the option to retire in case you want to continue to work, you know, until you're a lot older. Because there have been some business owners that you know work until their 80s or even 90s if they're still able to. But yeah, so don't worry about it. It's not too late. I'm going to talk to you about some options that you're able to do. So hopefully, yeah, you like them, and let's get to it. So the first one is that you can do what's called defined contribution plans. So defined contribution plans. So in these types of plans, some examples of these plans are, you may be familiar with, probably the most popular one is like a 401k account. There's also 403bs if you work in the health industry, 457s. There's profit sharing plans, as well as ESOP, or employee stock option plans. So quite a big variety of these plans that you're able to do. Now, the thing about these plans is that they do have quite a bit of large contribution maximums. So for 2026, you're able to put in about $72,000 into these plans. And in case you're 50 years or over, you're able to put in what's called a catch-up contribution of $8,000. And if you're between the ages of 60 to 63, if you're between the ages of 60 to 63, you're able to put in a catch-up of about $11,250. So this catch-up does not take in, is in addition to the 72,000 amount that you're able to put in. Now that 72,000 is a combination of things. It could be a combination of elective deferrals coming from like a 401k, which the max there is 24,500 in 2026, and the other portion could be the business contribution or the employer contribution. So combining all that combined is where we get the $72,000. And then, of course, if you add another 8 or 11,200, you're in the $80,000 mark. So you could do quite a bit of that. And so, for example, if you're able to do, let's say you're 50 years old and you want to put in for 10 years that $80,000, max it out for you, and you invest it in an investment called the S&P 500 index, which invests in the top 500 companies or so here in the US, and historically has earned an average compound rate of return of about 10%. So if you do that, then in 10 years you'll have about 1.2 million in your retirement account. So you'll be able to accumulate a good amount of money into that plan. So that's one type of plan that you can do. It's called defined contribution plans. So now let's go to the second one, which they're called defined benefit plans. So defined benefit plans. So in these types of plans, these are what's probably the most popular one back in the day that businesses used to do. It's called a traditional defined benefit pension plan. Now, they're called defined benefit plans because the employees, including the business owners, because owners are employees of their business, their benefit in the future is defined. So they know what they're going to get in the future, like 50% of your income, 80%, 40, whatever amount. Whereas defined contribution plans, you know what's going in the future, or what's going into the plans each year, but the future value is not determined. Future value is based off of each employee's account performance. How they manage it is up to them, right? It could be stocks, bonds, cryptocurrency, ETFs, even in real estate, whatever. You can do a lot of different things in these plans. So now the great thing with defined benefit plans is that, today they're not used as much, but for business owners, there's a wide variety of different types. There's a traditional defined benefit plan. There's also other ones like a money purchase, and a very popular one called the cash balance plan. Now, these plans, you're able to put in hundreds of thousands, if not millions of dollars. So you could put in quite a bit more than what you could put into the defined contribution plans. A huge amount of money. And for example, let's say you're able to put in $250,000 into this plan. Again, you do that for 10 years, and you invest it like in an S&P 500 index, 10% return average. So that means in retirement you could have probably close to about 4 million or so in your defined benefit plan pension. So these plans, because you're able to put in a lot more contributions, you can more quickly accumulate large sums of retirement benefits. So that's number 2. And the third one that I'm going to go over with is, it's not a traditional retirement plan per se, but it's still something that can be used for that, and that is what's called a brokerage account. So number 3. Brokerage accounts. So a brokerage account, otherwise known as like a taxable account. So it's a non-retirement account, and in these accounts, similar to like a bank, a savings account, you could put in, there's no limit to how much you could put into this plan, into these accounts. You could put in hundreds, millions of dollars. You have $10 million, you have $100 million, boom, you could put into your brokerage account, no problem. So the great thing, in addition to these, is that besides the no contribution limit, if in case you need to access these funds, there is no tax penalty like there is in these, or potential for these. If you're below us like 59.5, you could incur a 10% penalty for taking money out, whereas these, there is no penalty for that. And in a brokerage account, you also are able to take advantage of what's called long-term capital gains rate, or LTCG, long-term capital gains rates, because the retirement plans can be subject to, depends on which ones you use, like a traditional, pre-tax version, you'll get taxed when the money is taken out, or if you do a Roth accounts, those are taxed now, and when you take money out, they'll be tax-free, but they'll be subject to, if they're are subject to taxes, they'll be subject to ordinary income tax. Whereas long-term capital gains rates in a brokerage account, if you invest it efficiently in order to get these rates right now are either 3 types, or either 0, 15, or 20%. So 20%, even at the highest, is lower than the highest currently ordinary income tax rate, which is at 37%. So it's basically almost half. And then, of course, that's federal taxes. If you include like high income tax states, like Texas, or where I live, not Texas, New York, or where I live in California, then potentially your overall tax rates could be, above 50 or higher percent. And even 20% is less than half of that. A brokerage account could be subject as well to what's called a net investment income tax on top of this 20, which is an additional 3.8%. So technically it's about 23.8 or so. But still, that's still lower than the ordinary income tax. But the great thing about the brokerage account is that you could also potentially harvest some of those taxes, meaning there's ways that you could manage this account so that you could lower your tax burden. It's called tax loss harvesting, which you can't do in retirement accounts. So with these, what it means is that, let's say you sell some investments at a gain, you could potentially also sell some other investments that you have at a loss and realize that loss, so that those investments that you sold at a gain, the gain and the loss kind of cancel each other out. It's called, you got to know how to do that in order to take advantage of that. And but that is possible, and that could potentially decrease your taxable gains on these accounts in order to do that. And then the other thing about this account, well, also similar to the retirement accounts, is that you could take out a loan on this account. They're called security loans or asset-backed loans. You're basically putting the account as collateral, and you take out and you put it like a line of credit based off of this account. So you're able to access funds on a tax-free basis, no penalty, and whatnot. It is similar to, like I mentioned, retirement accounts, that you could take out a loan on these as well. But the good thing with these is that similar to well, the retirement accounts usually have limits on how much you can do with that, whereas these usually the line of credit is usually a little bit higher of what you can do. And again, no taxation on the loan proceeds that you can use for whatever. You could, invest in your business, consolidate or refinance other debt, invest in other investments like real estate. I mean, whatever. Tons of other things you can do. But yeah, no taxation on there. And then lastly, I guess number 4 is that you could do a combination of all these things. You could do potentially all of them if you have enough cash flow for your business in order to do them. It's up to you. It's up to what you're able to do. The retirement plans, you may have you're going to have to include other employees that are eligible for these plans. So you may have to put some money in for them. Maybe not as the maximum that you're probably going to put for yourself, but you're going to have to give them a certain minimum due to IRS rules. Which if you do we could give you like a free proposal, or you could go to any other advisor that you work with that does these plans, and they could kind of give you a little quote and illustration regarding how much it would cost you to do these plans, including what you have to put in for your other employees as well. The brokerage account, you don't have to worry about the other employees. That's only you. So again, you could do a combination of these things or all of them. That's up to you. But in summary, the main thing I want you to take from this is that, you have options and you have time. You're still able to do something. And as long as you have the cash flow, you can do it. We'll find a way to do it. So thank you for watching this video. I hope you gained good information from what I talked about regarding your options and what you're able to do. It's not too late. If you feel someone needs to know this information, go ahead and share this video with them so that they're able to gain that knowledge and gain that information. And of course, we're here to help you in any way that we can regarding these things. Thank you again for watching. Like the video if you liked it, subscribe to my channel, so that will help me out to make more videos. And until the next video, I wish you guys lots of financial success and all the best.